Ladies and gentlemen, welcome to Wealth Dom. I'm the portfolio manager and your host, Norbert BM. In today's topics, we have the Federal Reserve has cut rates for the very first time, the S&P, the Dow Jones and Gold reached new all-time highs, General Mills and FedEx reported earnings, a potential takeover for Intel, the Fear and Greed Index finished on greed last week, and we made some changes to our portfolio, and we're going to talk about them and why we did them. First things first, let's take a look at the last week. We had on Monday absolutely nothing. But then on Thursday, we have from Germany the economic sentiment, which came in worse than expected. I live in Germany, I know why. Then from Canada, we have the inflation rate, which came in better than expected. Then from States, we had retail sales, which came in also better than expected. Then on Wednesday, we had from Japan the balance of trade. From Great Britain, we have inflation rate report, which came in as expected. And then we had the big one. First we had the building permits. They came in better than expected. And then we had the Federal Reserve cut, which came in not as expected, or actually not what economists thought that is going to come in, but what the market thought that is going to come in. And we're going to talk about that just in a couple of minutes. Then on Thursday, we had from the UK the interest rate decision. On Friday, we had inflation rate from Japan, and also Bank of Japan maintained interest rate. This is what the big fear, that interest rate would be cut, and that would trigger again a carry trade. And also from the UK, we had retail sales, which came in, well, better than expected. So let's take a look at the week ahead. It's going to be an interesting week. We're going to have in the G20 countries, the biggest economic countries in the world, we're going to have from Germany on Monday, the manufacturing. Then on Tuesday, we're going to have from Australia interest rate decision. They're forecasted to maintain interest rates. On Tuesday, we're also going to have from Germany business climate. I believe it's going to be worse than expected. Then on Wednesday, we're going to have the CPI from Australia. On Thursday, we're going to have consumer confidence. The consumer is not confident in Germany at the moment, I can tell you from personal experience. Then from the United States, we're going to have durable goods, and Fed Chair Powell is going to talk on Thursday. And then on Friday, we're going to have from France a interest rate, inflation rate, and then on Friday, we're also going to have core price index, personal income, and personal spending from the United States. Okay, this week we had some earnings, two major earnings actually. First of all, we had earnings from General Mills. This is also kind of a pulse of the consumer, which they came in on revenue. They beat revenue. They beat also earnings. And the stock rose, not that much, but it also actually did. It rose and then it came down. Before the earnings actually dumped, then it went up and then it came down again. So pretty much ended on flat. So the consumer was normal, but then FedEx. FedEx came in on Thursday and just missed. Massive miss. Missed on revenue, missed on earnings. Stock fell almost 18% in, I believe, 2 days, actually, at the earnings. And then it started to climb a bit, but it ended the week on red. Now, is this a buying opportunity for FedEx? That would be interesting. We had FedEx reporting earnings and had a extremely bad guidance. For the entire year, they said they're going to a even worse third quarter. But historically, FedEx did this a couple of times. So they came in worse, then it came in better. And also we're expecting after October to the entire stock market actually to take off. So is this a buying opportunity? We wait. We are waiting to see what happens next week. If next week nothing immense happens, maybe we're going to consider buying some FedEx. It also yields a pretty interesting dividend. In the worst case, we're going to end up with a bit of dividend, but never buy a stock for the yield. Okay, next up, let's talk about the Fed. So the Fed did cut rates for the very first time. Economists expected 25. Also, I myself expected 25 basis points. They cut 50 basis points. The market, right after the decision, went down. Then the next day, market said, had a really good nice sleep. Everything is up again. And it stayed up, and it's also hit new all-time highs. We're going to talk about that just in a couple of seconds. I also did my video on what will happen if they cut 25 basis points, if it cut. So I was wrong on 25, but I was right what will happen on 50 basis points. I did predict, educated guess, that the market will close on positive after they cut rates. So it didn't close on that day, but the next day and also the entire week, it just went up and up. Not much. That's what I meant. And Monday, I believe, I created that video on what is the risk in the market. Actually, last week I created that video. So what is the risk in the market? What is the risk return? And the risk was high, not very high, high, and the return was mediocre. And that is exactly what happened. The risk proved itself to be high because the market sold off right after that, and the return was mediocre. Let's just be honest. The market did go to new all-time high. So let's actually jump into the very next point, which S&P went ended the week of 1.56% with a all-time high of 5,713, and also, as you can see in the chart, it sold down and then it went back up, and then that was also the futures. They ended on a bit of a negative tone there, and also the Dow Jones ended on positive with closing the week with plus 1.52%, and also returning a complete new all-time high, ending on 42,131. Okay, so let's talk about Intel and its potential takeovers. Now, Bloomberg report, this was on Friday, this came out of nowhere. Intel surge, you can see here, Intel had a really good day, not this one, but this one, really good day on the news from a Bloomberg report that Qualcomm made a takeover approach on Intel Corporation. Now, Qualcomm is not actually a chip maker per se for laptops, for PCs, but it's a chip maker that designs major cell phone chips. So the deal would make sense for Qualcomm. It would give it a chip manufacturing capability, which they did try to kind of go after some laptops. Now, the deal also makes sense for Intel Corporation, as it would give them a new owner that could help them with a bit of cash. Now, on the news, Qualcomm fell, Intel rose, and let's be honest, full disclosure, I am an Intel owner. I know why. Also had a couple of discussions about this on this very show. Now, Intel was just recently in the news for cutting expenses, for stopping 2 plants, one in Germany, one in Poland, and trying to split the foundry business from the rest of the business, which really took Intel to, it had a bit of a jump in its price. But this would be a really intelligent move from Intel, and I always said Intel should be bought by someone. They say Warren Buffett, Qualcomm will also do. Intel shares surge, but the deal is still in the early stages, and there is no guarantee that this will go through, of course. The deal would be a major consolidation in the chip industry, and would have a major impact on the market, of course. But the Intel story is worth following, so I'm going to keep you up to date. I'm going to keep my eyes on it, and we're going to report as soon as we have some new news on this. I'm going to keep holding Intel until at least 2025. If they don't deliver, then regardless what the price is, I'm going to sell Intel. Okay, that's it for the news. Let's talk about the changes in my portfolio. Okay, so let's see what happened last week. First of all, we are at the current yield of 2.94% in the portfolio. You're going to see why just in a couple of minutes. On the interest rate and dividend, we received dividend from Alphabet, not a lot, 20 cents per share. Because do still own Alphabet. It is a, where do I have Alpha? Let's see here. There we go. It's a 3.47% of the portfolio. This is not a huge position, but still we do own some shares from Google. Now we are a current free cash position. We changed our free cash position. We're going to come into this just in a couple of seconds. We are at 19. There's a cash position. We are at 19.70. We are at 17.92%. And we are receiving a 3.5% on our cash per year. Now, this is going to change as soon as the ECB again changes their rates. So if this changes, this is going to also change. Now, this is the cash that we are going to receive interest on. Let's move on to our S&P index, where we dollar cost averaging it. In it, we increased the position to 1.02% of the portfolio. I'm going to show you again. This is this position right here. This is just a S&P 500 ETF that we're dollar cost averaging into it. If you saw my video last week on 5 stocks I recommend, or 5 stocks that I recommended to buy for beginning investors, if you missed that one, check out that video. I'm talking about the top 5 position that you should invest in as a beginner. And this is one of them. This is actually one of them. For the rest of them, check out the video. and also explain why I think that this is one of the most important positions that you should invest in. So we increased the position by 0.36% to 1.02% of the portfolio. Now we're going to increase this a lot if there is a in the market, and then we're going to lump sum into it. I'm also talking about this in the previous video, when I think you should do that and why I think this is smart and why not. Okay, now let's talk about buying and selling. Actually, I'm going to, yes, let's talk about this. So, surprise, I have a surprise position for you. We added GameStop. Why is that? Well, let's look at GameStop. Where's GameStop? There we go. We increased our GameStop position to a 1.1% of the portfolio. Why did we do that? Also, look at this beautiful candle. Speculative. This is a trading position. Okay, we do here at Wealth Tom grow and protect our wealth, but we also trade. There is a lot of volatility in the market. You have to take your chances. I'm opportunistic. That's how I move, but only on small positions. So we increased our position to 1.15%, 1.10% of the portfolio. You're going to see the entire report as always on my blog. Also, the link is down in the video description. And as I said, with our cost average into the S&P 500 distributed. This is a distributed ETF. We are receiving take a look at this, a dividend of, does it say here? Yes, a 1.09% annual dividend on it. Okay, now we did take a new position, a pretty big one. This right here, this little fellow, somebody already caught it, a 5.52% position in the Vanguard US Treasury Bonds Distributed ETF. This little fellow is a mishmash of multiple distributed bonds, long-term and short-term bonds. These peaks right here, I'm also going to explain really quickly why we did that. So let me just show you the entire diagram. So this is the ETF. You want to look up for it. Now this is on GetX, is on multiple platforms. This little fellow has the following properties. It rises at the moment. So we saw in the last couple of years that bonds and stocks did not do what they should do, reverse themselves. So if bonds are down, stocks are up. If stocks are up, bonds are down. But it's happening now. And we are in a position, this is yielding a 3.84%, actually more than my free cash per annum. And this is yielding monthly. So if we have a rough month, I'm going to get yield. If we have, actually, if you have a good month for stocks, I'm going to get yield. If you have a bad month for stocks, just check this out. Do you see what just happened here? Let's close this. And then here, for example, do you remember this date? The 31st of July. And this one, August, 1st of August, that was the big carry trade. It was Friday and then Monday. And then the bonds reversed. So bonds jumped when stock fell. Let's compare it here to the SPY. Okay, here's a comparison. The red one is the SPY. You can see here it fell exactly where these rose. You can see this right here. Let's also draw it. This right here. This right here. Then the S&P rose, stock fell. S&P fell, stock rose. Exactly what is happening again right now. S&P is up. The bonds are falling. So S&P falls, bonds rise. S&P rises, stock fall, bonds fall. Sorry about that. And let's see what will happen next week or in the upcoming 2 weeks. This is why I added a big percentage of my position, to allocate a big percentage now to this position. If nothing happens, going to get some yield. The position is in a sell signal. So if this is going to get worse, I'm going to add to it, just add to it. It is roughly, so how much can I can actually, if it just hits this highs again, it's just 2-ish something, a maximum of 3% gain. It's nothing, but I'm happy with it. I'm protecting myself, and if the bonds rise, I'm going to sell the bonds, buy stock. Okay, so this is the only position that we bought. I thought about buying Salesforce, also FedEx, but I didn't. We're going to maybe next week. I don't know. Okay, so what did we sell? Let me just bring this back in here. Oops, and to draw this line. I'm also going to include this diagram into the blog. So what did we sell? Well, we sold 50% of CrowdStrike. You know, CrowdStrike, it had that huge dump when they had their problems. Wait, there we go. So we reduced CrowdStrike to 1.66% of the portfolio due to a bit of a surge. It has, let's just go to 1 year. It is on a buy signal. It's almost over its 70 RSI. If this is going to go in here, I could sell everything, or maybe another half of it, because this is going to come back. I'm not 100% sure. Tinfoil hat, but I predict that before the elections, we are going to retest those 100-day highs of the S&P, or lows, sorry about that, the 100-day moving average of the S&P. And that is where I'm going to take out the big guns, boom, boom, and look at stocks. Okay, that's basically the only thing that we not sold, but reduced our weight in that position, and that's basically it. So I'm going to leave you with the following thoughts. The S&P is at all-time highs. The Nasdaq is not at all-time highs, so it could catch up again. We had our very first rate cut. It was a big one. It was a 50. They stormed out the gates with 50 basis points. I think that we are about to have another small correction. If I'm wrong, so be it. Let me hear your thoughts in the comment section below. What do you think? With this being said, I'm Robert BM. Catch you next time. Take care. Bye-bye.